I guess one of the more obvious conclusions to why everyone is talking about Disney stock is because of the falling stock price, right? Disney stock is down nearly 60% off its highs from 2021, trading at a price near the lowest it's been in the last decade. But there's deeper answers to that question, like the big transition between the content consumption from cable to streaming, which I think is driving this big decrease in the stock price. So let's take a look at Disney's streaming segment and what's going on there. The big theme in the most recent update from Disney was the big drop in Disney Plus subscribers, right? Namely from Disney Plus Hotstar. I have a list here of Disney Plus and Disney Plus Hotstar, and you can see year over year, Disney Plus Hotstar subscribers decreased by 24% from 52.9 million to 40.4 million. So it had investors asking, what's going on here? Isn't this a growth business? Shouldn't it be adding millions of subscribers every quarter? What about Disney Plus domestic US and Canada? That also decreased by 1% year over year to 46 million from 46.3 million. And then you've got the other side of the business, the linear cable subscriptions, that's falling precipitously, and investors are justifiably concerned. And that's causing the stock price to fall because investors are saying, hey, you've got one side of your business that's declining rapidly, and this growth engine, supposedly growth engine, is not growing all that much, right? Decrease 1%, up 2%. Overall core up only 1%. Disney Plus Hotstar down 24%. Hulu up only 1%. Live TV plus SVOD, the cable, the streaming version of a cable subscription, down 2%. So, understandably, investors are concerned. So, management spent some time talking about the streaming segment. Specifically, the third quarter operating losses improved by 150 million from the prior quarter and by about 550 million year over year. So while the company is losing subscribers or not growing subscribers as rapidly, the business is firming itself. It's putting itself on firmer footing, not just spending a lot of money for growth. And Disney Plus core subscribers grew by nearly 800,000 during the quarter from the previous quarter, not from the previous year. The company's focused on overall economics versus pure subscriber growth, right? Not just looking for empty calories, looking at economic growth, economically viable growth. Still, they expect that in the fourth quarter, which is Disney's next quarter, they will see Disney Plus core net additions rebound with growth both domestically and internationally. Disney Plus core average revenue per user increased by 11 cents because the company had been increasing prices, adding an advertising tier in certain international markets as well. And we could see that in their average revenue per user. Disney Plus core $6.58, Disney Plus US and Canada $7.31. So these subscribers are much more valuable in terms of average revenue per user than the Disney Plus Hotstar subscribers, which generate only 59 cents per user. Just 59 cents. 1/10, less than 1/10 the value of Disney subscribers, Disney Plus subscribers domestically and internationally, but still core subscribers, not Hotstar. But the area where Disney lost most of its subscribers was in the Hotstar segment. And that's been a focus of the new management team that's come in along with the new CEO, is focusing on profitable segments, profitable markets, not just focusing on growth, not just focusing on subscriber growth so that they can report to investors, hey, look at all the millions of subscribers we added. Yeah, but how much are those millions of subscribers costing you, the company? And are they benefiting the bottom line, or are they just empty calories generating just 59 cents average revenue per user? So, If you're an investor in Disney that's concerned about the streaming segment, I would not be so concerned about the streaming segment. I think management is heading in a prudent direction, focusing on profitable growth, not just empty calories. And ultimately, I think this will lead to a more profitable business, a more profitable transition for Disney overall. So, this is why I think a lot of investors are talking about Disney stock. Understandably so, the stock price is down significantly. It's not going to be an easy transition. Disney's not going to have an easy time converting customers from the cable to streaming while also trying to generate a similar level of profitability in the process. All right, but that's all I've got for this video. Thank you for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.